Hey everyone, and welcome back to the channel. If you're planning for retirement or already enjoying your golden years, today's video could literally save you thousands of dollars. We're breaking down 5 tax traps that could quietly wipe out your retirement income in 2025, and how to protect yourself before it's too late. So grab a coffee, hit that subscribe button, and let's make sure your hard-earned savings stay in your hands. Let's start with the first trap, the RMD avalanche. You've saved all your life in your traditional 401k or IRA, and you've done everything right. But here's the catch. That money has never been taxed. The IRS has been waiting patiently, and at age 73, they come knocking. These required minimum distributions, RMDs, force you to withdraw money whether you want to or not. And those withdrawals are taxed as ordinary income, just like a paycheck. Now that can create a snowball effect. Let's look at John and Susan, both 74. They've got $1.4 million in savings and receive $60,000 a year from Social Security. But once RMDs kick in, they're forced to withdraw $54,000 in 2025. Their taxable income jumps to $114,000, enough to push them into a higher tax bracket. And that's not the end. Because their income is higher, 85% of their Social Security becomes taxable. And 2 years later, they'll also pay higher Medicare premiums, known as IRMAA surcharges, adding another $2,000 to $4,000 per year in costs. That's the RMD avalanche. One event triggers another, and before you know it, your tax bill and healthcare costs are both rising. How to avoid it? 1. Do Roth conversions in your 60s. Pay taxes now, when your rate might be lower, to reduce future RMDs. Roth IRAs aren't subject to RMDs during your lifetime. 2. Still working at 73? You may be able to delay RMDs from your current 401k, but remember, you still owe RMDs on IRAs or old 401ks. 3. Use qualified charitable distributions, QCDs. If you're over 70 and a half, you can donate up to $108,000 in 2025 directly from your IRA to a charity. That donation counts toward your RMD, but doesn't increase your taxable income. 4. Plan early. The first RMD is due by April 1st of the year after you turn 73, but taking 2 RMDs in 1 year could double your taxable income. Timing is everything. In short, manage your withdrawals before the IRS manages them for you. Next trap is the stealth tax on Social Security. You might think, wait, I paid into Social Security my entire life. It should be tax-free. Unfortunately, that's not how it works. Depending on your total income, up to 85% of your Social Security can be taxed. The formula is based on something called combined income. That's your adjusted gross income plus any non-taxable interest plus half your Social Security. And here's the frustrating part. The income thresholds that determine whether your benefits are taxed haven't changed since 1984, more than 40 years ago. If you're single and your combined income is over $34,000, up to 85% of your Social Security becomes taxable. If you're married and over $44,000, the same thing happens. With 2025's cost of living adjustments, more retirees than ever will cross those outdated thresholds without even realizing it. Example: Sarah is single and gets $30,000 in Social Security. She withdraws $25,000 from her IRA to cover bills. Her combined income is $40,000, $25,000 from the IRA plus half her Social Security, $15,000. That's above the $34,000 threshold, so most of her Social Security becomes taxable. She thought she was just withdrawing a little money to live on. Instead, she triggered a tax she didn't expect. How to stay out of this trap? 1. Plan your income sources carefully. Withdraw from Roth IRAs or savings accounts first. Roth withdrawals don't count towards Social Security taxation. 2. Delay claiming benefits. By waiting until full retirement age, or even 70, you not only increase your benefit, but can do Roth conversions before your Social Security starts. 3. Watch for small changes that tip the scale. Earning a bit of interest, selling investments, or taking large withdrawals can all raise your combined income. 4. Know your state's rules. Some states, like Colorado, Kansas, and Montana, still tax Social Security, while others don't. Moving to a more tax-friendly state can save you thousands each year. The key takeaway? You can't stop taxes from applying, but you can control how much of your Social Security gets taxed with good income planning. Trap number 3 is a big one, and it's called the Medicare IRMAA cliff. IRMAA stands for Income-Related Monthly Adjustment Amount. Basically, it's a surcharge that higher income retirees pay on top of their standard Medicare premiums. The part most people don't realize is that IRMAA is based on your income from 2 years ago. So your 2025 Medicare premiums are based on what you earned in 2023. The standard premium for Medicare Part B in 2025 is around $185 per month. But if your income is just a little too high, say over $106,000 single or $212,000 married, your premiums jump dramatically. They can rise to $259, $369, $480, or even $628 per month per person. That's not gradual, it's a cliff. If your income is $212,000, you pay standard premiums. But if you earn $212,001, you move up a tier and pay hundreds more every month. Example, Mike retired in 2023 and got a $10,000 bonus plus stock sales. That extra income pushed him slightly over the IRMAA limit. Now, in 2025, he and his wife are each paying $74 more per month for Medicare. That's $1,700 per year they didn't plan for, all because of a small one-time event. Here's how to keep IRMAA from biting you. 1. Know your brackets. Before doing a large Roth conversion, property sale, or stock transaction, check the IRMAA thresholds for your filing status. 2. Spread out income. Instead of taking one huge distribution, split it into smaller withdrawals over multiple years. 3. Appeal if your income drops. Retired recently? Lost a spouse? You can use Form SSA 44 to appeal your premium increase due to a life-changing event. 4. Use Roth money. Withdrawals from Roth IRAs don't count toward IRMA, another reason to build tax-free income sources. 5. Think ahead. A high-income year now can raise your premiums 2 years later. Always plan 2 steps ahead. Trap number 4 is one many retirees never see coming: the state tax surprise. You might think moving to a tax-free state like Florida or Texas will solve everything, but that's not always true. Each state has its own rules, and some of them want to keep taxing you even after you move away. For example, California and New York have clawback rules that let them tax pensions earned in their state. And if you sell your house when you move, you might owe state capital gains tax, even if the federal government lets you exclude $500,000 as a married couple. Example, Linda moves from Illinois to Florida in March 2025. She thinks she's done with Illinois taxes, but Illinois says, not so fast. We'll tax your income up to March, plus anything sourced from Illinois for the rest of the year. If she didn't change her driver's license, voter registration, or file a part-year resident return, both states could claim her as a resident. How to avoid double taxation. 1. Move early in the year. The earlier you move, the easier it is to prove your new residency for tax purposes. 2. Change everything right away. Update your license, voter registration, insurance, bank address, and apply for a homestead exemption in your new state. 3. Keep documentation. Save leases, closing documents, and bills showing your move date. If questioned, you'll need proof. 4. Check all taxes, not just income. Some no-income tax states make up for it with high property or sales taxes. Always look at your total tax burden, not just income tax. 5. Ask before you move. A CPA who handles multi-state returns can help you avoid headaches and possibly save thousands. Finally, the investment income tax bomb, also known as the net investment income tax, or NIIT. If your income exceeds $200,000, single, or $250,000, married, you'll owe an extra 3.8% Medicare surtax on your investment income. This includes interest, dividends, capital gains, and rental income. And remember, this tax stacks on top of your regular capital gains tax. Example, Robert and Linda are retired, living comfortably off $80,000 a year. They decide to sell their rental property for a $300,000 gain. That sale boosts their income to $380,000 in 2025, pushing them into NIIT territory. Now they owe an extra 3.8% tax, or about $11,400 on top of capital gains tax. And because their income spiked, they'll face higher Medicare premiums in 2 years. One transaction caused a 3-layer tax hit. How to manage or avoid it. 1. Plan big sales carefully. Spread them across multiple years if you can. Selling half this year and half next year can make a big difference. 2. Use tax loss harvesting. Sell losing investments to offset the gains from profitable ones. 3. Explore opportunity zones. Reinvesting certain gains in approved zones can defer or reduce your taxes. 4. Own municipal bonds. The interest is generally exempt from federal income tax and doesn't trigger the NIIT. 5. Think long-term. Taxes don't happen in isolation. One big gain can impact future premiums and your tax rate. A financial planner can help you create a multi-year plan that saves you money overall. All right, let's wrap it up. We've covered the 5 major tax traps that can wreck your retirement income in 2025. 1. The RMD avalanche. Forced withdrawals that trigger higher taxes. 2. The Social Security stealth tax. Outdated thresholds that punish savers. 3. The Medicare Irma cliff. One extra dollar can raise your premiums. 4. The state tax surprise. Double taxation when moving. 5. The investment income tax bomb. An extra 3.8% on your gains. Each of these traps can cost you thousands, but every one of them can be avoided with smart planning. The biggest mistake retirees make is assuming their taxes will automatically be lower once they stop working. For many, it's the opposite, because years of smart saving can now turn into years of higher taxable income. So what should you do? Plan early. Map out your income sources, conversions, and distributions over the next 5 to 10 years. Work with a retirement-focused financial advisor, or CPA, who understands how taxes, Social Security, Medicare, and investments interact. Because the tax code rewards people who plan and penalizes those who wait. If this video helped you understand your retirement taxes better, please give it a thumbs up, subscribe, and comment below. Thanks for watching.